Good morning and welcome back to the Opportunistic Trader for December 19th, a Fed day, an exciting day. It should be a lot of action going on. Markets took out the low last night on the reopen on the S&P off of FedEx light guidance going into 19 and 20. I think you're going to see a lot of that going forward from a lot of these entities, but FedEx is a big one, and it's involved in shipping, all of that. So, pointing to maybe weakness. Yesterday's action, tried one trade in Apple and it did not work out. Lost again. So hopefully today we'll come up with a couple of good ideas. We're probably going to be inactive until after the Fed at 2:30. Press conference start. Still think the market is going to trade lower. I don't know how exactly it plays out, but there are a bunch of different scenarios, obviously. But I think it would be not right of them to move forward and say that they're not going to do anything next year. I think they'll come out and say they're data dependent and they're more at a neutral stance. I do think that the hike, if they do it today, will be negative. It may have a relief rally, but stocks, even this morning with the S&P up 15 handles before it was up 20 handles, I'm looking at stocks across the board and they're not up. Facebook is down 2%. They released personal information off Messenger to their clients. So I don't really think that bodes well for them. Apple is up 13 cents. Amazon is down. Google's up slightly. So across the board, stocks are kind of flat. S&P's up 15 in a dead cat bounce. I think people, everybody's calling me and they're saying the same thing. Are we going to rally today? I hope we rally today. Are we going to rally big? Everybody's looking for the big rally, and it may come, but I'm thinking more the other way. And if we break 2,500 on the S&P, it could get really skittish. And I think Trump will have his scapegoat going forward. But it's interesting. I was looking this morning, and I don't think Trump has tweeted about the stock market since the beginning of October, when he said it's a great day for the market, it's up 450. He was actually quoting prices. So I think that game's over. If we close here at the end of the year, he's averaging less than 7% a year, which is not the greatest market president of all time, and he's losing that. And the market is in the midst of a correction. I think the S&P is off about 14 from the high. I know they're using the high as the correction number. We're only down 5 for the year, but if we go down another 5, 6, we're going to be in a bear market, which we believe at the Opportunistic Trader will happen. It may not happen into the next week and a half, 2 weeks of the year, but will happen at the beginning of next year. Micron came out with earnings last night. That was a touch light. The stock is down 10% at $31. Middle of this year, the stock was $65, so it's more than in half. A number of stocks are like that. Nvidia's in half. A lot, Apple is down $70 off the high. So there's inherent pain in here. They may bail them out today, but we're not 100%. Volatility is down a little bit. It's at 25. Interestingly enough, when we made the high in volatility on this last run down, it was about 150 SPU points ago where we hit 29. So again, this volatility is not really giving protection across the board. And looking at stocks in general, they don't look so great. The bond has been going straight up for basically a month. The yield on the 10 years probably below 2. Was it below 280? No, I'm saying last night. Yeah, so last night it probably hit just below 280 on the uptick because it's about 5 off the high. So we're back to 280 from 3 1/4. Um, Interesting to look at that. I don't know really what it means. The dollar in general is a touch stronger, but sort of mixed. In general, the euro's up, pound is down, and the rest of the stuff is kind of flat. So, the big trade is oil. Oil has been oil went down 11% in the last 2 days. So on top of going down about 30%. So it's down about 40 off the high in about 2 months. If we ever had anything like that, the world would not be a safe place. But overall, you know, it's not really much of a takeaway here. Pre Fed, it's just sort of gaming what you think will happen by having the market here rather than where it was at 4:30. Takes a lot of panic out of the market in front of the Fed. There's quiet action. It really hasn't moved much since I've been in, so we expect it to be a bit quiet. Japan broke 21,000 last night on the futures, trading at 20,945. That is down pretty big. It's down 10% in the last under a month. So that's getting hit as well. China down 1%, sort of in the range, but lower end of the range. And today I think is critical in general for the market to see if, I think it's just about whether we can hold today. If we can hold that yearly low, I think we go back down at some point and test it. We should take it out, but again, maybe yesterday was the test. It tested there a couple of times, so we'll see. But it should quiet down after today in general. And Vince is joining me. I was wondering his thoughts
Oh,
on the world.
oh, there you go. Well, I'm a nihilist, and I think it's all a waste of time. No, I'm just kidding. Seriously, two things you said that I wanted to reiterate before circling back to the Fed was um, Vol is definitely underperforming. Now, I'm not advising people to just go out and short Vol, but if you look at it as a correlation or as a trade itself, uh, volatility is will come in if we go up. The VIX will come in if we go up, and the VIX should blow out if we go down. But it has underperformed in sell-offs, and that's that could be for many reasons. Some of them being it's the end of the year and people aren't buying puts because they don't have the free cash to do so. It's the end of the year and people aren't expecting much movement. But there's a lot of end of the year type of stuff that affects trade flows and mechanical things that interfere with the fundamentals of how people positions on. So I like the idea of vol being not a good hedge if you're bearish in the market. Buying puts may not perform this time. I do want to bring it back to the Fed if we can, because there's some terminology there that the Fed uses a lot that is thrown around on media outlets that I don't think is really explained, and I think we could concisely explain some of them. First of all, people talk about things like uh, neutral rate. What is the Fed neutral rate? Well, and I'm not saying this to be sarcastic or mean. The Fed doesn't know the neutral rate. It doesn't mean they're not striving to learn it, but once they see it, they'll know. It's kind of like, I don't know what it is, but when I see it, I recognize it. So that's why you don't really know what the new neutral rate is, first of all. Second of all, just looking at the math and looking at how I think the market has factored in, a couple of definitions can come out of that. So, for example, it is my opinion, actually consistent with Larry's, that the Fed will likely revise their forecast. Now, their forecast for 2018 was 4 rate hikes. I think we're going to get a rate hike today. That's my opinion, but that's not the important part of it. Fed, and they were also calling for 3 rate hikes next year. I think the Fed officials will likely revise their forecasts. Now, that means we'll probably see by the end of the day, especially if the stock market drops, the discounting of future rate hikes in 2019 going from 3 to 2. So, you know, like forecasting all economic variables, there is a range of estimates for this neutral rate. Most Fed officials peg you closer to 3%, with a range between 2.5 and 3.5%. But uh, the movement towards this is a cycle, and what I'm leading into this is that I don't think today there's a statement that we're only going to raise 2 times, but there's definitely a move in that direction. That said, as I think Larry has implied, a dovish hike, I'll call that a dovish hike. A dovish hike seems to be the most widely expected outcome. So while in several scenarios I see the market selling off and then rallying, on a dovish hike, I also say to myself, well, if a dovish hike is already, believe it or not, discounted in the market, even after the sell-off, we could have a relief rally on the dovish hike and then a resumption of the sell-off. So there is room for the market to go lower because the market, believe it or not, even after the sell-off, is still expecting a dovish hike. And if we get a dovish hike, it's not necessarily bullish. And if we don't get a dovish hike, or just we get a hawkish hike or a hike, that's bearish, beyond bearish. And that's actually a shout out to Tracy Shigro, who mentioned that to me yesterday, and I thought she was crazy at first, but I thought about it, and it's quite possible.
Hey Vince, what is a hike? Or is this football?
Yeah, well, I didn't want to say hawkish hike, a neutral hike. Yeah,
hike.
Well, yeah, I actually translated hike into Dutch, and it comes back raise, or to go for a walk. So a hike, I think, would be a football. I don't know. I can't run with the analogy, but yes, it's definitely a football faux pas, a neutral hike. But yeah.
So your general thoughts. So your general thoughts. Your expectation is a dovish hike coming out of today.
Well, I don't have. Well, a dovish hike seems to be the most widely expected outcome.
Right.
And so I think the markets have discounted that. And you look at the market after the sell-off and you say, well, doesn't seem that way based on the market sell-off. And I would say to you, yeah, but if there wasn't a dovish hike coming, being discounted in the market, we'd be even lower. So that's how I'm looking at it. And that's an opinion, but based on what I think the market is doing. That said, you look at things like Fed futures or credit default swaps. They may be discounting Fed hikes of 3 at, I'm going to make a number up, 80%. Like last month, it was like a 90% probability of a December rate hike before stocks sold off. But the stock market, in my opinion, was only discounting a 60% rate hike, chance of a rate hike. The stock market is eternally optimistic because it's the nature of the beast. And the point is, I think there's always a little bit more hope in stocks than there'd be in something like bonds, which I think are more efficiently pricing the market. Bonds could be saying that we're going to stop raising rates. Bonds could be looking at the market 2 years out, but stocks are looking at the market 2 months out. And so my opinion is that a person needs to have the scenarios in hand the most likely scenarios: dovish hike, aggressively dovish hike, which will never happen, and hike, or just hike with no change in opinion, or no hike at all, and handicap those and think about your probabilities that those things will happen. And then once you've done that, think about how you think the market can react in those. And I think Larry has kind of distilled that down, saying that if he agrees with me that the market's discounting a dovish hike, then my explanation could be an explanation for what he's already stated, that we could go lower after a relief rally. And there's your dovish hike being a buy the rumor, sell the news sort of scenario. I hope that helps or makes sense.
It does. It definitely does. I agree with the hike. I'm going with the hike. But
but they're definitely. I mean, they're going to move towards 2 rate hikes from 2019.
Well, the market has priced in 0 right now for 2019.
I'm sorry. Who has priced in 0?
The actual bond market right now. If you look at the Fed futures for next year, it's basically under 1 hike. Yeah, it's gone from 2 to 3 to basically slightly in between 0 and 1 and closer to 0 at this point.
Okay, so if that is a reliable indicator, meaning it's consistent, whether every model has slippage, but to the extent that that's reliable, then God help us, because if they don't do anything, if he doesn't come out there and say I'm never raising rates again, we're probably going to go lower. If that's really what the bond market is saying, that's crazy. I'm not saying the statement is crazy, but then we've got more downside. I think the Fed doesn't care about the stock market going lower until the stock market itself starts impeding the economy. We have above expectations performance. As I think you said it yesterday, Mike, quoting Rosenberg, and Larry and I were joking about it. We have 4% economic growth. We've got 3% unemployment, and we've got a 10-year bull market. What's your best guess for where rates should be? And,
But
7%.
but the other side of looking at the entire environment right now is FedEx, which is the real world. They came out yesterday with really pessimistic numbers for the global economy. They said
Right.
Europe specifically is slowing down. Europe has a lot less demand. They're seeing a lot of uncertainty about what's happening in China and Asia based off of the U.S. trade. And that's exactly what it comes down to, even when people look at next year. And the Fed can't come out with a year and a half dot plots and things like that, because we don't have a clue where trade is going to be. We don't know what's going to happen with the trade talks between U.S. and China, and that's a massive thing. And so that's, I think, part of why they need to be data dependent and need to be nimble and can't be saying, and that's what they've acknowledged. Look, we can't, there are too many variables right now. Brexit, does it go smoothly? Does it not go smoothly? There are a lot of things over the next 6 months that we need to see how they play out. But FedEx specifically down 7%, and the chart's up right now. Larry was taking a look at Micron and a lot of the tech names, but this is FedEx, which is really a barometer of the global economy. In January of this year, we traded $280. We're right now trading $170.79. So we have dropped significantly this year, and that's always been seen as a barometer.
But I want to pose a question, okay? If the market was at record highs right now, what would the Fed do next year?
Right, I agree. It's more
3 hikes
dependent.
plus.
Right.
Okay,
Agreed.
so really all this is a skittish market with a bunch of weak hands begging, including the president of the United States, begging the Fed not to make moves based on stock market prices, and that's what this is.
You're right. I mean,
the economy
I can't agree with that more.
The economy can slow here, but none of the numbers, or very little of the numbers in general, are slowing. What is slowing is CEOs freaking out because what you just said, their stock price was 280 and now it's 180. Okay, they're not coming out and going things are good. They're saying things are bad. So it's all based on stock prices. If we were where we were 2 months ago, or 3 months ago, right now, there would be 100% chance of a raise today, a raise in January or February, one in the second quarter, one in the third quarter, and maybe one in the fourth quarter. Because we sold off 10% or 12%, there's no hikes, nothing left. So,
I agree. It's stock market dependent from that perspective.
Right.
Absolutely.
So that's what we have.
I think the Fed is economically driven or data driven, but let's be clear about something. You can't ignore the stock market if it goes to 2000, because the tail then wags the dog. You could say all you care about is economic data, but when the stock market goes to 2000, liquidity pools freeze up, and at that point, it does affect things. I just think that this Powell put is not where people think it is, and I think when you look at what the Fed wants to do is, I think the Fed doesn't mind the stock market coming off as long as the descent. But Larry's opinion is that Powell is weak, and my opinion is that Powell is strong. But the trend is towards weakness. He's got a lot of pressure on him, and even though I think it's folly for Trump to be focusing on stock prices instead of the economy like every other president does. But Trump has masterfully laid the sell-off at Powell's feet. And although Powell may not be dependent or tied to the president, I do believe that the Fed should not be as independent as they are. And I'm not talking politics. They can only hear me right now. So the Fed is independent, and whatever your politics are, maybe the Fed shouldn't be so independent. Maybe it hasn't been so independent. Maybe they would do what the president wanted if he wasn't in their face all the time. But the reality of it is that, Powell is looking to, I think, he'd be happy with a lower stock market if the descent was controlled. Now, as day traders, as active traders, this is really good. As investors, it's really bad because retail investors, volatility is a tax on retail investors. They tend to sell the low, they tend to buy the highs as the market's chopping lower because they don't know what to do. They're in a panic, they don't have a plan. But active traders thrive in a volatile market. When you have a market that's 0% year on year change, but has a 2% range every day, that's great for active traders. So a good active trader, and you could put a bet on before the number comes out, I don't care, but a good active trader reacts and gets ready to trade after the number comes out, because the first trades that come in when a data when the Fed talks or an event or earnings happen are people that trade because they have to, not because they want to.
Right now, S&P is up 15, Nasdaq's up 35. The VIX is trading 25.11. It's actually only down about 2%. What are your thoughts on the VIX, and what do you think on the VIX after the announcement?
I think the VIX is a short. I've been saying it against being short the market. And the reason why I like that trade is because going into the end of the year, if the market just sits, you're going to make money because VIX is going to come in. If the market rallies, the VIX is going to come in much more than the market. And if the market sells off, the VIX will have a hard time significantly making a new high through $29 or $30. Now, all bets are off if the market crashes, but I don't expect that because of seasonality. So that would be my thoughts. So be short in a ratio VIX versus the futures. So
I guess with all the difficulties, the question is also, here we are at 25.51. If we go into the meeting at 25.51, if they hike rates as expected and then give a more dovish sort of tone, and if we were to rally, is that a rally you'd be looking to sell? Or if we sell off, is that a dip you'd be looking to buy? Are there specific levels or anything you're looking at as actionable?
I'm going to look for market action. You have the market acts after the number or after the raise. I don't have any levels. Obviously, we all know the level of the low of the year. If we take that out, it's a matter of whether we drop another 20, 30 handles off that, or if we hold in that level. So we'd have to look at action after the number on the upside. It's a little bit scary selling into strength today because to have a 50 handle reversal is not the biggest deal, but it's going to be interesting overall to see the market reaction. And as a trader, I'd like to look at the market and how it reacts and react to that. So right now I'm going to be opinionless, going to wait for the action. I do have a little bit of thought, but I'm not going to trade with an opinion today. So before the number, we're going to be light. After the Fed, we're going to look to put on positions both in equities and in futures, and we'll wait it out as we are.
The other topic for today and tomorrow is the triple witching coming up on Friday. Last time we spoke was 3 months ago when we were rolling June to December. That was basically the top. That was the top tick. That was the top. And, potentially, is there any chance this could be the bottom tick?
This will be the bottom tick for this run, probably Friday. If the market is skittish, they'll print this thing in the hole in a big way. So it'll be interesting Friday to see how.
I guess it also depends on price action today and tomorrow, based off of that. Today, so the schedule for today, we're going to be speaking with Adam Collins at 10 a.m. He's going to be talking about different opportunities based on seasonality and different things he's looking at. Typically, he goes over COT report. He's been out of town a little bit, so we'll get a brief update on COT, but some different thoughts as well. So if you have any questions for Adam, that'll be 10 o'clock. So then at 10:30, we do have the crude oil DOE report, which is pretty interesting, just given all the volatility in crude. So that'll be coming up at 10:30. Then at 11:35 or 11:40, Andy Labov, Commodity Research Group, is going to join us to talk about crude oil and also the DOE report. Then at 12 o'clock, Angie Setzer is going to be giving us a grain update into the end of the year. Corn right now 385, wheat 5.25, and soybeans are 907. So we'll get update from her on that. Then at 1 o'clock, Larry will be back on with questions and more updated levels, as will be right before the FOMC at that point, thoughts, things like that. So 1 o'clock if you have any questions, and then then we get the release at 2 o'clock and a press conference shortly after. So it'll be an active afternoon, an active day. We aren't expecting to do a whole lot before the Fed, but who knows? With this volatility, there might be opportunities. So we'll keep everybody posted. Any closing thoughts there, Larry?
Yeah, I'm looking at my equity board, and I see more stocks down than up. So I'm surprised we're up 15. I have Apple flat, Facebook down 2, Google up, Amazon down, the oil ETF is up slightly, the financials are down slightly, Goldman is down, Twitter is flat. Everything looks kind of mixed, and I'm surprised Micron's down 8%. FedEx is down, as you said, big. So I don't know how we're going to make this opening, but they come up with some esoteric stocks to do it. So my final thought would be, I'd like to see more strength in the underlying stocks in the market to move the market up here. I don't think the market holds into the Fed. We could be going into the Fed on the low of the year, so we'll see. We'll see. But again, we're up 14.50 now, and I don't see much up. So we'll wait till after the opening, and we'll be back to you after the opening with an update.